Hello and welcome back to The Note. The spectre of deflation hangs over the world and particularly over Europe. As we're starting 2014 in general, people are very optimistic for the world economy, but the single greatest fear out there, the single greatest doubt, is that there is a lot of deflationary pressure apparently at work. Could that yet put all those calculations out of whack? With me now to discuss this is the chief economist for HSBC here in London, Stephen King. Stephen, thanks for joining me once more.
A pleasure.
Let's start by taking a look at central banks who may be rather more successful than they want to be at the moment. Take me through what's going on in this chart, which shows inflation since the crisis.
What we have here really is a story that Japan recently has seen this very substantial rise in inflation, which is all to do with so-called Abenomics, depreciation of the yen and so on. But elsewhere, we've seen increasing signs that inflation is coming in significantly lower than target. So
most first time in yonks that Japan actually has a higher inflation rate than either Europe or the US.
Absolutely remarkable. So you might say, well, this is a relative success for Japan, or instead it's a relative failure on behalf of both the US and the Eurozone. And central banks there should be, in one sense, very uncomfortable about the fact that inflation is so low. Now, of course, you might say this is simply a lagging indicator of a lack of demand over the last few years, and as the recovery comes through, I think it's going to be absolutely fine. But I think that part of the reason for this is actually that Abenomics has had a peculiar impact in creating or exporting deflation to other parts of the world. So what basically happens is the yen's come down quite a long way, which has raised Japanese import prices and pushed up headline inflation in Japan.
Right.
But of course, if the yen's falling quite a long way, by implication other currencies are going up. And their strength may have contributed to these really quite significant downside surprises to inflation over the last year or so.
Now, how does that link in with the story we see in the commodities markets, which generally didn't enjoy the party last year either? Is that also a story about Abenomics, or could that be attributed to slowing growth in China, which is what many people often talk about?
I suspect it's more to do with slowing growth in the emerging markets more broadly. It's pretty clear that China itself has slowed down to a certain degree, although probably not quite as much as some people had feared. You look at countries like Brazil and India and Indonesia and other parts of the emerging world, all really been quite disappointing over the last few months, partly as a consequence, of course, of these very poor balance of payments positions that they've sort of built up over the last few years. So those economies have been much weaker than expected, and of course they tend to have growth which is quite heavily commodity rich. So as their economies slow down, that tends to have a bit of a negative impact on commodity prices in general.
Okay, now let's take a look at what might happen next, given the big, terrifying example of Japan.
Yes.
What happens if they stimulate inflation but don't manage to stimulate anything else?
Well, the big question in Japan, or the lesson in one sense for Japan, is what happened in the period from, say, 95 through to 97, because the red bars here show the performance of GDP over that period. And what you can see from the chart is that actually there was a reasonable cyclical pickup in GDP, which gave people the impression in Japan back then that this was the beginnings of a normal recovery. At the same time, inflation was remarkably low. Now, you might have said back then, well, if inflation is low, it's bound to pick up as a consequence of the recovery. Well, it did rise, but only because of the increase in the consumption tax, or the introduction of the consumption tax in 97. But actually, underneath all this was this persistently low and lower than expected inflation, which of course eventually moved into deflation.
Right.
And actually, I would say that in Japan's case, the causality was reversed. Whereas normally we think about growth leading inflation, in Japan's case, it's really inflation that has led growth. Too little inflation at the zero rate bound means you have problems with real debt levels, the burden of servicing debt goes up, the financial system remains weaker because you get an increase in non-performing loans. In those circumstances, you end up discovering that it's the low inflation that prevents the recovery from being sustained. That's a really big problem, I think, for central bankers today.
Okay, now this is all particularly problematic for central bankers because they have an asset bubble or potential incipient asset bubbles to worry about in various parts of the economy. That would normally argue for higher rates. Plainly, if you're worried about deflation, that should argue for lower rates. What are you suggesting central banks should do?
Well, it's a really tricky conundrum, frankly. But I think that the underlying problem is not so much associated with either asset prices or indeed inflation. It's really the fact that I think they're trying to pursue growth rates, which perhaps, because of supply side constraints and perhaps the impact of the financial crisis, are growth rates which are simply unachievable these days. We can't go back to the growth rates we saw in the 1980s and 1990s.
You can throw demographics into the picture there as well.
Demographics, signs that perhaps world trade is not quite so robust as was the case previously, a whole series of beneficial impacts of the late 20th century are now beginning to fade. But as a consequence of all that, the pursuit of faster growth than monetary policy can really achieve is in danger of creating asset price bubbles, and that's something which I think central bankers will again have to contend with over the next few quarters. Now, one way you can deal with it, of course, is to split the responsibilities, have an MPC, for example, that looks after the inflation story, and an FPC that looks after the asset price story. But getting that right, I think, is going to be a really tricky challenge.
Okay, Stephen, thank you very much indeed. I'm sorry if that's doused people's enthusiasm for 2014, but plainly this is a problem. If you have both a deflation problem and an asset price inflation problem at the same time, it's very difficult to cure both of them at once.